Good day and welcome to Phillip Live Discussion Roundtable. The topic of recession risk has become increasingly relevant as we navigate through these challenging times. Many are concerned about the potential impact of economic instability as the Fed is fighting the red-hot inflation, complicated by the recent bank run. Today, we have gathered a panel of esteemed experts who will provide insights into how individuals and businesses can navigate through this volatile period. We will explore various strategies and tactics that can help mitigate risks. So without further ado, let us start with our first questions for today. The latest non-farm payrolls report indicated a slight slowdown in the jobs market, with 226,000 new jobs added in March, slightly below the expected figure of 238,000. The job market seems to see some signs of moderation. On the other hand, while the recent CPI numbers continue to show some easing trends, core CPI remains sticky as it rose sequentially at a faster month-on-month pace than the headline. Kim, do you think the core CPI will be a major concern as worried by the Fed?
Okay, thank you, Wanda, for the questions. From the beginning of the year, we are seeing investors' worries start to rotate away from inflation and towards growth. While the latest US headline inflation continues to run further below the 9.1% pace recorded in June, core inflation continued the upward month-on-month trend, and the year-over-year print has exceeded the headline CPI. The balance of risk for US inflation remains on the upside, as reflected by the persistent increase in the shelter costs, food costs, and to note components within the core and services inflation remain elevated and rising. Adding to that is that the growth seems to weaken further in the US. If we look at the recent US ISM manufacturing PMI data, it has slumped to a 3-year low on weak demand. The Fed's dilemma is to strike a balance between inflation and economic growth. But in the wake of the collapse of SVB Bank recently, the Fed new dilemma is how to manage those priorities that I mentioned earlier amid banking headwinds. Fed officials scaled back rate hike expectations this year amid the banking crisis, but still raised their benchmark rate by 25 bps to a range of 5.75% to 5% in March, as they sought to balance the risk of a credit crunch with incoming data showing price pressures remain elevated. And also to note, tighter credit conditions also point to a weaker growth ahead. And this is not just happening in the US, it's also happening in the Europe. And our base case is that there's no systemic impact on the US financial sector. And if this remains valid, it's reasonable to expect the Fed to continue to stay focused on fighting inflation and push forward with its rate hike cycle.
Yeah, Dr. Tan, back to home, Malaysia. Our inflation is currently standing at 3.4%. Of course, it decreased gradually for about half year, but then 3% is still way above the average of Malaysian inflation. How do you think this inflation in Malaysia will trend moving forward, and how will this trend affect Malaysia business?
I think Malaysia is considered very lucky because the reason why your inflation is so low is because your oil price is being subsidized, and we are lucky in this sense. But although you say that, I think you should be also very concerned that when you go and eat outside, the price has also gone up. May also have gone up more than your 3%. Anyway, it's something that the government has to be very concerned. If you can control your inflation, that's good, because we are facing very bad time. The economy is slowing down. US not only have that inflation problem, they also have, they think that by increasing the interest rate, they will slow down the economy, will slow down the inflation. But sometimes you need to be very careful. Sometimes it doesn't work, or at times it works. So Malaysia, also need to be careful. You are in the stock market. Of course, later on, maybe we'll talk about that later on, about the stock selections and other things,
Okay, thank you, Dr. Tan. Raymond, in your opinion, when the current tightening cycle will come to an end, how do you view the market implied interest rate path, that there will be 50 or 75 basis point cut this year?
Okay, I think it's still very premature, right, to talk about rate cuts even happening this year, given that the market still expects the Fed to hike, in the next few meetings. So perhaps, you will probably get a clearer picture once the Fed actually signals that it will pause. But having said that, you can see that the entire bond market in the US is already inverted, it's below the Fed funds rate. 2 years actually dipped below 4%, right? And your 10 years, is about 3.5% already. So which indicates that, the bond market has already started to price in, rate cuts happening, whether it will be end of this year or early next year. So my take is that, bond market is sort of like, pricing itself ahead of the Fed, anticipating a rate cut, given the view that, the higher for longer kind of message being given out by the Fed may not be sustainable, in the sense that it would bring about a slowdown in the economy at some point in time. But because your core inflation in the US still remains stubbornly high, which is why the Fed rhetoric now is that they still intend to continue to hike the Fed funds rate. So I think, basically you have this tussle between the bond market and also the regulators.
Okay, thank you, Raymond. So for say a newbie, do you think we should start with corporate bond or treasuries? Because I believe treasuries is easier to study.
Treasuries, as in US treasuries?
Any countries.
Okay, if you were to look at government bonds, right, be it treasuries or MGS, that brings with it an element of trading skill. It is not really a sector that you may want to consider in buying and hold, right, to enjoy a yield or a safe return, because it usually means that, government bonds usually means that it is the lowest yielding bond in the market, right? So for instance, 10-year MGS, if it's at 3.8%, you can even get 3 months FD at 3.8% at this point in time. So why you want to go and take a 10-year duration bet on government bonds, even though it's zero risk? You buy at 3.8%, but you don't get the pickup as compared to even the 3-month FD. Even the time horizon is like totally different. So unless of course you expect the yield curve to basically collapse, right, or to flatten, then yes, you have that trading kind of element there, right? You go in today, maybe next week when Bank Negara announces that they may not they are going to pause and not hike interest rates further, then the market will rally, and then you can get out within that 1 week period, and perhaps gain like 10 basis points or 20 basis points. So as I mentioned, government bonds is a matter of more of a trading play rather than a kind of like a realm where individual investors can buy and perhaps hold it for whatever period of time. More on a longer term basis. Does that answer your question?
Yes. Thanks, Raymond. So if I am an investor investing long term, and I believe we will have a portfolio on hand already. It's like I already investing something, and then suddenly there's a recession hitting us. What should we do to minimize the damage to our wealth? Should I just cut loss or hold for better days ahead, Dr. Tan?
this is not an interesting question. My reading is that if you going to spend time investing and then suddenly face into problem, then you should spend your time evaluating fund manager like Kim Chu, like somebody else, yeah. And you wait until you get into trouble, and it's actually not easy to restructure because you may not be systematically doing that, So when it comes to the bad time, it's very hard to liquidate, it takes a long time to do that, So we are also in some way also very careful. We try not to also go into make mistakes, Yeah. So your question is very difficult in the sense. First, he must have a rojak. This rojak not so tasty, Yeah. But you have a very good rojak, then you have lesser problem. You just sell across the board, raise the cash, so that you don't take so much risk. In assuming that you read that the market is too high already, you want to reduce your exposure, have some cash, and when the market tank, you have the cash to buy. Yeah. The key is that his ability, his risk profile, his ability to take risk, how much the money he has is for how long period, and that's very key. Yeah. So you then restructure to meet your criteria. Although I must say, you can have all these criteria. At some point, they are also not performing, but you just hope that in the long run, you can outperform the index, and you can outperform the fixed deposit, you can outperform your inflation. That's your key. Your question is difficult in the sense that you are giving a portfolio that you don't know how to make this decision. Sorry, I tried, but yes, I came to answer your question. You asked a very difficult question. Yeah. Or maybe that's the interest that I always tell people that, okay, you should go and analyze the fund manager and whether he is the one who will make money for you. Just like I invest in Malaysia, we invest in great tax, we invest in hibiscus, we invest in we used to also shareholder of the tropic, and we make good money even before they become known. So, but once they are overvalued, you also need to be careful. They can be such a good company, they are overvalued for 2-3 years, they're not making any money. They are just stand still. Okay, I think it's a very difficult question,
Yeah, thank you, Dr. Tan. No worries. It's a good explanation.
Can you give some easy one?
Yeah, sure. Okay. Raymond, let's back to fixed income. So we have talked about the equity side. So how about the fixed income side? How can fixed income exposure complement a mixed asset portfolio to balance off the risk associated with the riskier equity exposure?
Yeah, well, for let's say any individual investors, right, and you want to do your asset allocation, you of course have your some part of your money, right, invested with skilled investors such as Dr. Tan, and Mr. Kim, right. But you also may want to have a portion that you want to, in case of market volatility. Okay, so you want a safe and stable cash flow, right? So it also depends, again, the type of investor you are, how much you want to allocate accordingly, right? And how much money basically you have at play. I mean, again, it's really a matter of personal preference, right? For fixed income, you would also have your money market funds that give you that liquidity whenever you need it, right? But you also have the longer term bond funds, which may give you, a so-called stable yield of 4 to 5%, depending on what the interest rate environment is. Okay. Of course, there are also some points in time when these are just basically, a no-brainer. For instance, I mentioned, when 2-year treasuries were at 5%, you just close both eyes, you buy 2-year treasury at 5%, what really can go too wrong, right? Even you talk about the terminal rate of 5.5%, having a 2-year at 5% in US treasuries, that's, I think, a very, very attractive deal. Or even for Malaysia, just 2 years back, or maybe just more than a year back, when your 20-year MGS was at 5.5%. Okay, anyone going into a 20-year or 30-year bond at 5.5%, if you have been following, the level of interest rates in Malaysia over the last, 20 or 30 years, very rarely would you see government bonds touching 5.5%, right? Then you don't even have to wait for EPF every year to announce their dividend, right? You have this portion in government bonds giving you 5.5%, and government bonds usually are also very liquid. You can easily exit at any point in time. So there is another element, right? The type of the period that we are in. Okay, 2 years ago when interest rates just shot up very aggressively because the market was just so bearish, and markets, as you know, always overreact during periods of volatility. So during those times, it is also a very good time for you to buy into bonds, and that can give you, a higher so-called yield or rate of return.
Okay, thank you, Raymond. We have one last question before we end the session. So Malaysian market has been trading at a low valuation for quite some time. As mentioned just now, it's currently trading at negative 1.7 times standard deviation. So do you think it is time to go in aggressively? Kim, what do you think?
Yes, as we mentioned earlier, the broader market is seeing some declining trend, but ultimately the most important consideration, like what Dr. Tan has said earlier, is that we have to identify companies with some quality attributes within it. Okay, companies with a sustainable business model that can be resilient against any economic downturn, companies with low gearing, with strong financials, and a competent management teams. And companies with these attributes often have a significant competitive advantage and may be equipped to achieve sustained growth over time. And this approach actually helps investors to minimize potential losses during time of market volatility. Within Malaysian market, we see opportunities in selected reopening plays such as gaming names, retail REITs, selected consumer names still have a leg to go. Ultimately, our focus is on opportunities within the quality growth name space. Thanks.
Okay, thank you, Kim. So we hope that today's discussion has provided you with valuable insights on how to maneuver through this volatile time of having this recession risk. So remember to stay informed and proactive in your approach to managing your finances and investment. By implementing the strategies and tactics discussed today, you can position yourself to weather the storm and emerge stronger on the other side. Thank you for joining us, and we wish you all the best in navigating through these challenging times.